For any founders listening that have those metrics, please email us. We'll have investment in your account within a week.
Yeah, like just call, email, carrier pigeon, whatever. We'll drive to you with the briefcase.
I think we talked about 3 and 4 times liquidation preference. They've come back out with a new offer, 8 times liquidation pref.
8. It's huge.
If we're going to look at what percentage of companies accept harsh terms and then go on to achieve greatness, you also have a look at the companies that don't accept the harsh terms and just try and bootstrap when they're in that last resort phase. Because I'm sure it'd be comparative in the graveyard. If you are in the struggle, don't let self-pity creep in, because the reality is good businesses will find a way through regardless of the cycle. And shit businesses off the back of tailwinds will get funded. Doesn't mean they're a good business. Doesn't mean there's going to be an outcome for them.
How are we on this absolutely freezing morning?
It's cold. And I've chosen to start fasting. And so I'm off coffee and all sorts of things that I would otherwise be using to just feel better.
Wait, Aaron, what type of fasting?
Intermittent. So aiming for a 20-hour fast each day. I've done this before and
yeah, cool.
It worked. I'm carrying a lot of fat on the gut.
No, we know. We know.
In the sprint to the wedding, trying to lose a bit of that.
Oh,
yeah.
Wedding shredding.
Yeah. Watch this space.
Jack, what have you been up to?
I didn't play rugby on the weekend, so I had a pretty chilled out weekend actually. But besides that, Aaron and I have just been getting on top of a lot of the compliance stuff. So it's been a good start to the week, getting on top of that, getting rid of all the administrative stuff that none of us like to do, but you got to do it.
We had a rad night in Adelaide. We hosted our debrief, London debrief. Lessons from London is what we called it, on Monday night in Adelaide. That was good to catch up with the crew.
Yeah, unfortunately, I missed out. But while you were doing that, I was at dinner with a few VCs from around the country that had come up to Brisbane, and that was really great. Chris Gillings from Cut Through Venture had put on a bit of a dinner in the city. It's the first time I've been into the city in ages, because it turns out most of Howard Smith Walls was closed. But no, it was good.
Is that for renovations?
Oh, Monday night. Apparently, during winter, they close Monday, Tuesday nights, and it's only the Felons Bar for a few hardcore ferals that go there now.
It's so Brisbane. Monday and Tuesday night, just dead in the city.
Yeah. Oh, mate, come to Adelaide. It's dead every day. I don't know. Sunday's not a thing here.
It was going off at the State Library at the little gin tasting that we had, Jack, on Monday night.
Oh, yeah. How exciting. Come to Adelaide. We'll take you to the State Library.
Calm down, guys. So that was a good dinner. Really good to connect to different parts of the VC ecosystem that are at all sizes. There's the billion under management down to the none under management. Somebody kindly said, I really like the memes you used to post on LinkedIn, but you haven't done any. It's like, yeah, the problem is I've given up my other social media and I used to steal everything from Instagram. So when you don't have any Instagram, you don't have anything to share. So I've literally got no value to add this ecosystem anymore, it seems.
Who even are you without memes, Don?
It was interesting that crowdfunding was discussed as that becomes a bigger and bigger part of the ecosystem. And a lot of the energy was positive, and how do we find a way to support it? But it wasn't hard to default to some of the risks and some of the concerns that people had. And one of the things we discussed is, as part of our process, whether it's an angel group or whether it's a VC, you're looking at this raise in terms of how much are they raising? Does this either get them to cash flow break even, or does it get them to the next milestone where they're really likely to raise? And one of the challenges that we at least perceive is that whatever people are willing to invest, they raise that amount, the cash is handed over. But actually, if that money doesn't get you to the next milestone, you're in a lot of trouble. And we know ourselves, we've looked at deals, and if the other investors don't come along or they don't capture enough dollars to get there, we pull the deal. We can't do it because the risk is just too high that they're not going to meet the milestone and they're going to fold. And so I think that is a fairly significant one that this ecosystem is going to have to solve, because we looked at a number of companies that had set, this is my target. They only raised a fraction of that target. They still banked that money. What's going to happen in the future?
Yeah, it's interesting. On Monday night in Adelaide too, a lot of the questions from the floor were around the investment landscape in the UK and what we saw there as a view over the horizon of what might be happening here. And crowdfunding came up again, but also, venture debt and what David Holson had shared about potentially valuing your IP and having banks lend against it and all these kind of changes. And they're all fraught with risk if not correctly applied. So interesting times ahead, though.
Yeah. So let's just recap on a couple of other discussion points from previous episodes. So there was a follow-up article in Capital Brief by Bronwyn Clune talking about Sendle that we had spoken about before. And the article says, Federation's Sendle deal draws intense VC scrutiny as fresh terms are offered. So in the previous article, I think we talked about 3 and 4 times liquidation preference. They've come back out with a new offer, 8 times liquidation pref.
8. It's huge.
For the listeners, for every dollar this investor puts in, or at least in this round, I believe they're altruistically sharing these terms with other investors if they want in. But for every dollar that they put in, the first $8 has to come back to them in the event there's an exit.
Yeah, so clearly struggling. But like I say to my kids, rule 0, don't get dead. And look, it sounds like they'll survive, at least this phase.
At the dinner on Monday night, what we thought would be interesting data is what percentage of companies that accepted more than a 3 times liquidation pref went on to actually be successful.
That would be good data.
Because if you're accepting more than 2 or 3 times and you're accepting 8 times, something is really wrong because you haven't been able to get better terms. And from an investment perspective, I wonder what percentage of companies actually go on to achieve greatness. And the hypothesis around the table, at least, was probably pretty small, because when a company is in that phase, often there's sunk cost fallacy going on. There's hope as the primary risk management strategy going on.
But I suppose for founders listening, like if you're accepting these terms, it's typically a last resort. So if we're going to look at what percentage of companies accept harsh terms and then go on to achieve greatness, you also have to look at the companies that don't accept the harsh terms and just try and bootstrap when they're in that last resort phase. Because I'm sure it'd be comparative in the graveyard.
Yeah, that's an interesting. So you're saying not accepting these types of terms and therefore not closing a round, you go on. Yeah, I see what you're saying.
And like the typical scenario would either be to accept these terms to give you a little bit of extra runway to maintain the same cost base, or totally gut the team, reduce runway and go back to a very small team and try and rebuild. So it'd just be interesting to see the outcome.
So Chris, if you're listening, I think there's a space for Cut Through Venture to do some more data analytics from the ecosystem.
Yeah, it's a little bit extra work for you, Chris.
It would be interesting data too on how many, like all the kind of changes in terms each quarter. Like I know that'd be a bugger to collate, but geez, it would be interesting.
And Chris and I did have a chuckle at the magic of editing, given what was happening during that podcast, from internet issues and the family issues and the stops and the starts. It came together really well.
The magic of delete.
Yeah. Now, I thought we'd just quickly touch on this one because this normally resides in the Sharts. But there was an article that's come out by Christopher Joyne, who I think is one of the best macro strategists Australia has. This was in the AFR, and says, this rule suggests that the US is on the brink of recession. So we've been talking about a lot of data sets that were pointing towards recession. The only question was when. And then there's been a few data sets that have actually started to move into recessionary vibes. But this article, he points to a rule called the SARM rule, which has correctly identified the inception of all US recessions going back to 1950. The SARM rule of thumb is not precise, mainly because of how it's calculated. But effectively what the rule is that they're looking at the 3-month average increase in US unemployment. And when the 3 months average increase gets past a certain threshold, in this case 0.5, that has been a metric that has said this is the beginning of certain things happening that ultimately lead to recession. Now, the article also talks about the inversion of the US yield curve. That's the 2-year and the 10-year yield curve. And it's been pointing to recessionary vibes since 2022. Now, a lot of people said that the inversion of the US yield curve has now become a false signal. A lot of economists have pointed to that in the post-COVID era, there was a lot of cash sitting in people's bank accounts. And what this article says is that the delay in recession from inversion from the yield curve could be attributed to the fact that the US consumers built up record cash buffers during the pandemic worth the equivalent of 2 years economic growth, which they then spent over 2022 and 2023. And so what it's saying is that the yield curve, don't throw it out just yet, there was actually this extraordinary one-off item, and it looks like we might be back in business of
Yeah, interesting. So like a 2-year lag just because of fuel in the tank.
just the amount of cash. Now, why it's important is not to try and be a macro guru and forecast everything or try and be too cute, but I think it is important to understand what kind of season you're likely to be moving in. And the season that we're coming out of has been high growth, moving into lower growth. And if we're moving into a recessionary environment, if you're especially B2B company and you're expanding into the US or countries that are affected by the US, it's a very different vibe in recession versus growth, having CFOs and CEOs scrutinizing every cost item on the P&L.
Yeah, and even just like sentiment transfer. Like we consume so much out of the US in terms of media and coverage and sentiment that we tend to mimic even when the numbers and the data shows otherwise.
We get to talk ourselves into negativity. So the main point is understand the season you're going into, but always be ready, always be prepared. And there was a post from Marc Orchard from Planet Startup.
Yeah, I like this. He distinguished investment ready from ready for investment. And I think part of what he touched on in there's a lot of programs and support to help companies with their pitch deck and all the kind of mechanics of being investment ready. But that's different to being ready for investment in terms of having quality business fundamentals that make you attractive and appealing to an investor. And then he also shared what that looks like in 2024. And what he described for a post-seed raise you need to look like is growing revenues and or users at 200 to 300% year on year with high gross margins greater than 80%, ideally recurring subscription model with a CAC payback of 6 to 12 months and a burn multiple of less than 1.
And for any founders listening that have those metrics, please email us. We'll have investment in your account within a week.
Yeah, like just call, email, carrier pigeon, whatever. We'll drive to you with the briefcase.
No, but I think it's really helpful for founders, especially those that are stuck sometimes saying, I deserve investment or why can't I get investment? I think it's helpful sometimes to at least benchmark yourself. Then you can see if there's a gap, and then you can start to make a plan towards closing that gap. Sometimes that gap can't be closed, and that's why the word pivot exists.
Yeah, no, it's a really good point because often I've heard founders talk about comparables, like investment rounds out of the US, for example, and the basis they're comparing it on is purely we're in the same space and we're doing X, Y, Z, but they haven't actually gone deeper to understand the metrics and how that company is performing compared to their company, and also the factor in a bigger market and all these other factors. So it is important for founders to benchmark themselves and know what that data is in the current climate.
A lot of the time, if you're not hitting these metrics, what we find is that it's a lack of focus. And Jack, this is probably one of the weirder segues, but poor Charlie's Almanac awaits me. So for listeners at home, Jack had read Poor Charlie's Almanac. What is it? A series of 11 speeches by Charlie Munger of Berkshire. And it's bloody great.
Aaron, you should definitely buy the book. That was the one. So that was the one that I bought in the UK. Hey, Don, we got you back now, but we lost you.
The point where he said media something. Yep.
Have you got me now?
Yeah.
I know why it is. The gardener moved the Starlink yesterday and I never put it back. Hold on.
First world problems. My gardener moved my Starlink. Let me just go to the other acre of my property to move it.
Yeah.
Look at that. We can see you in actual HD now.
Sorry, Don, you got up to the said media company, but then we didn't hear anything after that.
They talked about investing in a media company that had a lot of broad titles, generic titles. And I think the words he used is that they got absolutely hosed by the competition because the competition then came out with a travel magazine, started to get niche. But then where they really got hosed was they started to go into corporate travel magazines, and they really started to create these very focused, really small niche businesses, but incredibly high margin. And then using those high margins, then they went wide. So even 50 years ago, the same bloody patterns playing out.
I tell you what, it was good on Monday night in Adelaide, hearing the mission delegates on the panel talking about what they learned from the UK market. And one topic that came up was focus, the need for focus, and the ability to compete in a big market like that requires niche focus. It was like, they've been listening.
But it's like what Ed from Octopus said in the podcast with us, tilt. So if you're not getting the numbers that Marc Orchard has talked about here, you need to focus, in my experience. You then achieve these numbers, and then you tilt into the other areas that can then keep that growth going. Now, if it was that easy, everyone would do it, but just pretend that it is, and off you go. And this, I think, conversation then dovetails fairly well to another post on LinkedIn by Peter Walker. So yes, be ready and have all of these conditions, but actually there's a bit of luck. There's some things that you can't control, and what you can't control is the environment that you're going into. And I'll bring this up on the screen, but what Peter released was a moving data set. Please stand by. So I'll read the post first. When you make a Series A depends a whole hell of a lot on when you raised your seed round. And if that seed stage was in the last few months of 21 or the first half of 22, you're playing on hard mode. Each line in this chart represents a set of companies that raised their seed rounds on a specific quarter. So what we're going to do is I'll just hit refresh on that, because this data set, so this is each of these lines represents a group of seed stage startups. They're grouped by the quarter and the year of their seed raise. Now you can see at least 40% of every cohort in 2020 raised a Series A within 3 years. Then usually the quarter cohort of a given year are pretty tightly correlated. But actually things started to change in 2021 where Series A starts falling sharply. And for those listening online, the data set is effectively just 0 to 12 months along the bottom, and then on the left is percentage. So this is the percentage of companies that have then gone on to raise their Series A depending on when the seed round was done, and it's just showing how hard it's gone.
Yeah, I'd love to see this data, not just for seed, but also for Series A and how many go on. But yeah, I think for founders, when you launch and when you raise your round in the broader cycle of the investment landscape, they wouldn't naturally think about. But if I was to draw something that, what can founders take away from this? The founders that right now are out there trying to raise pre-seed and maybe even pre-Series A, as tough as it bloody is in the market right now, it's better to be here than to have been raising that seed round back in that peak of the market where valuations were through the roof, and to come off that cycle. So as tough it is right now, I think you're entering at a better point in the cycle for longevity and durability.
Yeah, and I think you can't really time it. Like a founder can't time where they are in the cycle. So if you are in the struggle, don't let self-pity creep in, because the reality is good businesses will find a way through regardless of the cycle, and shit businesses off the back of tailwinds will get funded. Doesn't mean they're a good business. Doesn't mean there's going to be an outcome for them. Funding just means you're taking on more risk, and it has no effect on achieving an outcome.
I'd throw into that too, Jack. Like, good businesses can become unstuck in the boom times by taking on too much capital and behaving and making poor decisions based on that. Yeah, you're spot on.
Whether you think you can or you think you can't, you're probably right.
I tried explaining that to my kids on the weekend. It didn't go down well.
Well, Aaron, if you think you can explain it or you think you can't explain it to your kids, you're probably right.
Oh, that's so true.
Look, there isn't any good segue to this next one.
I'm trying to think of one. No.
But there was a report out last week that Tesla tumbled because of a delay to their Robotaxi unveiling.
But okay, one of my reactions to this is, okay, it tumbled because of that. Surely we've just factored in now that this is forever delayed. Like, why?
Which Robotaxi fucking unveiling? I thought we already had that.
Anyway.
I'll read the article. Tesla is delaying its planned Robotaxi unveiling in October to allow teams working on the project a little more time to build additional vehicle prototypes. Fraud. I haven't made this up just for effect for the episode, but at 2 a.m. this morning, Matilda comes in, needs to go to the bathroom, no problem. But now I'm a bit annoyed that I got to get back to sleep. So I start thinking of different things. Part of it was thinking about London mission and then the upcoming US mission. And obviously I've drifted into a dream state because I dreamt that Elon did a session for the mission. But it was weird. It was like in a Saudi Arabian tent thing. My vibe was like really positive. Like, I was happy to have him here. There was no general negativity. But then he got really tired and needed to have a lie down. And then I protected him from people taking photos. So deep down, am I actually empathetic and really an Elon lover?
What time is the appointment with the psychiatrist to go through and unpack that dream?
Anyway, speaking of fraud, a lot of listeners may have remembered the big ructions in the tech market when Bill Wang of Argos blew up. I don't know if you remember, but back in 21, 22, there was just this massive blow up in public markets. And what had actually happened was that this firm had really been driving a lot of the markets by buying options and futures and derivatives on the underlying companies, which then sent these companies spiking to the moon. Now, what ultimately happened is it turns out that they were committing a bit of fraud behind the scenes. And what this article talks about is how all of the investment banks got taken by him. And because his fraud trial had to analyze what happened in the lead up and then the days after them not being able to make their margin calls, it was just amazing reading some of the behind the scenes stuff. And one of the things that occurred to me is that people just don't realize, even at the big end of town, how much this is based on trust. I think it was, let me get the right, UBS had billions of dollars of margin loans out to these guys. And one of the emails was, "Hi, Andy and Will. We've tried numerous times to connect with you, but we can't get through. Senior management is frustrated with the lack of engagement and the limited sell down of your positions held with UBS. Please let us know how best to connect. Thank you, Derek."
Jeez.
UBS went on to lose $1 billion.
Wow.
But the star that came out of the court case was a guy called Rich Handler. He was the chief executive of Jefferies, and it sounds like he's seen this movie before. Jefferies is a New York bank. His decision-making style has now been described as the spicy margarita deadline. So his traders called him and said, Archegos have blown through their margins. They're not answering the phone. What he's reported to have said, "I'm going to get a spicy margarita and I want all of Wang's portfolio liquidated by the time I get back to the phone." They came out pretty well on top. Like Credit Suisse, they called a trader who had his day off and said, "Could you go in and sell down some of these?" He went and hired a bicycle. He rode his bicycle to the Manhattan office and then slowly sold it down. And ultimately, Credit Suisse lost $5.5 billion.
Oh, far out.
The broad theme of the article is nice guys finish last. And I think that one of the themes we see in entrepreneurship in general is that actually pace is really important. Being too nice gets you into trouble. And often what happens is people think that they've got more time than they actually have. They don't actually connect with the risk. They don't push hard enough. They don't push fast enough. And then events overtake them. Now, in this situation, I don't feel sorry for big investment banks that have lost billions upon billions of dollars, but actually the patterns still exist for early stage companies.
Yeah, definitely. And that nice guy finished last. There's definitely a pattern. The more successful entrepreneurs and investors we know, there's a nicety and pleasantness to them, but they have a sharp edge. There is a point at which they engage that when needed.
And they go hard, and they don't actually care what other people think. And it's a balancing act, right? We don't want to invest in absolute narcissistic assholes, but at the same time, underlying drivers and fears and paranoia and all of those negative connotations, if you don't have any of that, you ain't building a venture business. Anything your side, Jack?
Nah, that's a very interesting story, isn't it?
These are the ones that you hear about. Imagine all the stuff that happens behind the scenes that you never find out because there's no corporate.
Yeah, so true.
Now, some people don't want to finish last, like a lot of these investment banks did, but some people want to live forever. And Eucalyptus has come out with a new product. It's only focused on men. For $1,000 a month, it's a medical concierge service, comprehensive diagnostics, and a structured program to improve every aspect of your health. And so this is an article by Jack Derwin of Capital Brief. Have you signed up?
I can't say I did. I saw it and I thought, I was so curious to see what it was. But then, to be honest, I was a bit deflated when I saw, it's a kind of tailored program. I don't know. I was expecting some magic drug maybe.
You don't want to do the work. You don't want to do
all these things. It's much like founders. It's like we know what, it's the how and being held accountable on the how. So I guess if they're helping people, if they're helping men work out the how and be accountable to it, I can see this working.
The main point wasn't to raise it in terms of the actual product, but the reason why they're having to really innovate and drive hard with high margin things is that they really got onto the Ozempic bandwagon. I think the article talks about when they first started, Ozempic sort of drove $100 million worth of sales for them. Now the government has banned their ability to compound, I think starting from October, and shit's about to get real for them. And they've gone and I think created a product. What is it? 4,000 at the time of the article, 4,000 people had signed up. I think Jack and I had discussed, imagine having a product that's, so what's that?
4 mil.
There's some product market fit there somewhere, isn't there?
Yeah, I think as well as everything going on with Ozempic and having that approved, but there's also tailwinds in the whole health tech space, trying to go from reactive to proactive. Like you look at a dentist, it's a preventative, but you only go to a doctor once you've had an issue and it's all reactive. So I think there's a larger theme here and they're taking a bigger bet. And like Tim Doyle seems like such like a great founder. So it's going to be awesome to see how Eucalyptus go proving out this new product.
From a product point of view, I think it makes sense. You're right, Jack. And from a point of view of companies not giving up or just accepting things and saying, we've got to bring new things to market here, I think that's a good sign as well.
Yeah, I thought about the $1,000 as well. Like, and it sounds like a lot, but then you think like people pay for 3 PT sessions a week at $100 a pop. There's $300.
And you factor in what they're spending on supplements and programs and dieting, fad, whatever. Yeah, like holistically, the sum total.
And I think once they can prove out the benefit of being preventative, like it's not, you can't put a price on your health, right? So once you're detecting things early and really dramatically changing and expanding your lifespan, like I can see this becoming a normal thing.
It would stop you having to make up fake stories, Jack, in order to...
Yes, that is very true. Let's see, I'm not the person to try and sell $1,000 a month to, because I'm here taking issues, trying to get it free.
I'm happy to leave it there, Jack, unless you want to share your experience.
No, we can happily share. I suppose it has to go back to Elaine saying, go and get your testosterone checked, because then you've got a baseline, which makes total sense. So I went to the doctor, said I would like to get my testosterone tested, and then they were trying to charge me, I think it was $100. And I was just like, oh, come on. Like I had a bit of quick thinking, had to say there's a few issues in bed, and then got it for free and happy days.
Oh, I love it, Jack.
$100 is $100.
Yeah.
I downloaded all of my past blood tests and I actually threw them into ChatGPT and just asked for any insights. And then I started looking at what other data could I throw in here to correlate. So like throwing in my age. And then I was thinking like the future of this, like predictive healthcare, and especially when it's science-based, but if they start taking genetic data, like that layer on top, it's going to get super interesting, super fast in terms of longevity and the life expectancy.
And so what was its recommendations?
It was basically like, you're all good. No, that I'm looking for you to tell me something to do. And it just gave the basic things but it was good at actually picking out my cholesterol pattern over time. Like it did pick up a trend that was there. Yeah, I think what's missing though is this piece. It's okay, give me an integrated, holistic view of what should I be doing tomorrow when I wake up and what should I be consuming and what.
Yeah. Humans wanting to extend the longevity of their lives correlates a bit with founders wanting to make sure that their businesses survive for as long as possible. But there was a post, not last week, the week before, from a dear Schiffman. If you launch a startup, you'll probably fail. Those are the odds. That's a nice way to
full stop. That's it.
Start a post.
It's reality.
Yeah. And that's, so what he says, mature startup economies like Israel and the US, their local culture embraces the collapses as a necessary part of the process. Provided there was no fraud, dishonesty, or abject arrogant stupidity, investors and co-founders value the tuition in those other markets. In Australia, we have a different culture. We're still learning. I've always believed that the road to success is paved with failure. You cannot reach the destination without first traversing a painful road. Therefore, he says he loves the piece by Tess Bennett from the recent summit put out by Paul Smith at the Australian Financial Review. It's refreshing and I think essential to read for all prospective founders. And so the piece that Tess Bennett put out, and credit for, I think this is probably one of the first and only AFR pieces I've seen to actually deal with the reality of startup and venture failure without the ridiculousness of some of the other reporting. But the article talks about the co-founder and chief executive of collapsed property management startup Different, says that she hopes the local industry recognizes the value in entrepreneurs and their battle scars. And that founder was Meena Radhakrishnan. And at the time, Different had got quite a bit of press from the failure. Meena was the only founder of a failed startup to agree to appear at last week's Entrepreneur Summit. So this article's a little bit old, where she spoke about the trauma of her Airtree Ventures-backed company crashing and burning and the relative unwillingness of the local industry to embrace failure as a rite of passage. And I think with that sentence, I think investors and people in the ecosystem, I do think, pending all of the things Adir set up there, we do embrace it. It's often the narrow-mindedness and easy clicks of people in the media that seek to create a shitload of pain, where actually this is par for the course.
Yeah. Look, we featured in an article for a website, Whoopsie, where we made an inadvertent mistake on our website, and the way that was, and that's not even a failure. That's just a mistake that was made. But yeah, I think in the investment landscape and amongst founders, I think we're mature enough to see the value of, and we talk about it all the time, right? Like the true lessons and value come from the failures more than the successes. And yeah, I think we don't celebrate it, but we learn from it and we appreciate the value of it.
There are some examples where venture-backed startups have failed, and then the VCs back the same operator or founder to go again in the next one. And I can think of one, Birds of Prey, Blackbird, one of the founders there, and then backed them again in the next startup.
Which is the perfect segue to the next item, Jack, because that's what we're going to discuss. We could talk about Michael Fox moving to New York, and in a post that he did, he says it's official. We have our visas and his family are now moving to New York City. He says this is take two for him personally. In 2015, Katrine Fox and I moved from Sydney to LA together with 23 of the Shoes of Prey team as they took Shoes of Prey to the US market. They had an incredible partnership with Nordstrom and grew their sales in the US, but ultimately our consumer insights were wrong. The mass market consumer didn't actually want to design their own shoes. They ended up closing the business in 2019. It was a humbling experience and I learned a lot. Now being able to dust himself off and go again.
Yeah, I wish them well as a family in New York. Interesting New York market. While we're in the UK, we had heard from one of the guys that was involved in Fable Foods previously and talking about how hard the UK market proved out to be. So it'll be interesting to see how they go in the US.
Yeah, and another, just to go back to what we're speaking, another example, which is what we're going to touch on next. Danny, the founder of Milkrun, is like an outstanding founder. And I bet if he goes again, it would be such a competitive round to get into his new company. And that's just an example of a company that's failed. We embrace that it failed for a number of reasons. I think the chances of him being able to raise again are very likely.
Yeah, and I think that comes back to Adir's point. For the people that matter, so investors and other founders in the ecosystem, and not some parts of the media, for the people that matter, how you failed is the bit that determines it. And if you had a good failure, i.e. you got out with your reputation and there wasn't any of those things that Adir describes, having had a failure myself, there is an emotional rite of passage that has to happen. It is a significant loss. You can't just bounce back the next day. It takes years to get through it. But then once you get out of that trough of fuckery, it's taking those lessons.
Yeah, I totally agree. I think measuring behavior more so than outcome, right? Like behavior can be correct, but the outcome can fail, or you can fail on the outcome. And so I think, yeah, the causality of the failure is really important.
And so if we then take Milkrun, there was a post on LinkedIn by Archer Sampson. It says in 2023, Woolies acquired Milkrun for 10 million and he's been seeing it advertised everywhere. So why was Woolies successful when Milkrun wasn't successful? So what he puts out is, first, let's look at the economics of Milkrun. They were set up with micro stores across Sydney and Melbourne, and all of their delivery partners were employees. Milkrun had to pay rent, salaries, bike rental. In order to offset the overhead, Milkrun needed to achieve the right basket size and order volume. The value Milkrun brought was their The value Milkrun brought was their fast 10-minute delivery. People would buy only what they needed immediately. Their focus wasn't on achieving larger basket sales. It was on getting the volume so they could deliver 4 or 5 orders at once. Rolling out Milkrun in high density locations like Sydney's eastern suburbs was the right approach to reach volume. It allowed them to set up a hub and spoke wheel. But the issue was that the level of population density required just isn't here in Australia. Even the gorillas who operate the same model across Europe, where the population density is much higher, couldn't get there even after investing $1 billion. So why is Woolies having success? There's 2 big differences. They already have the infrastructure. Like they already have all the stores, and then they leverage the gig economy. Each order has a guaranteed return. There's no additional expenses for idle periods. And I think that's right. I was watching the other day and a car came down the driveway and I went, who the hell is this? And Libby had put in an order for some deliveries. It was a gig economy worker that had dropped it off. Happy days. And that's Woolies leveraging all of their own infrastructure. Now, some people in the media have said that all of this was clear to see, that it was never going to work in inverted commas. But I think coming back to Michael Fox's comment of that their consumer insights were wrong, here, clearly the consumer insights are not wrong, but obviously their assumptions around density and volume and all of those things, they just couldn't get it to work.
Yeah, and this is, it's very easy from the cheap seats to say we always thought it wouldn't work. And even a broken watch is right twice a day if it's analog. Like, the reality is that the point of innovation is to try and find a way to make these things work and conduct those experiments. And yes, all of this plays true, and I totally understand this article and what it points to, but that prior to that wasn't known. And I think that's the thing, that the nature of innovation, bringing something new to market, it is a discovery process.
So Adrian Bunter, who listeners will know from a number of great episodes we've done with Adrian, he put a comment on this post. He said, Milkrun's key problem was that it tried to grow too fast, and once opening a location, felt it couldn't shut any due to potential brand damage. GP margins were actually quite decent and growing. New product offerings could enable a much higher dollar margin for the same cost of delivery and acquisition. And to say Australia doesn't have enough density, is it correct? Sydney and Melbourne are actually some of the largest and most denser cities with high incomes that make it attractive for this model. High earners are less concerned by cost and happy to pay a premium for convenience, which delivers higher margins. So Adrian's got a counter view that in those high density areas, this could have worked, but actually they just tried to go too quick, too hard, and weren't willing to cut places when they turned out not to be right.
I like to look at the data for the density of the cities. Like when I think of a CBD like London with so many gig economy type workers and delivery services for everything. Yeah. And it would be interesting to see how that density has changed, like within a CBD location, like a centralized location, post-COVID with more remote workers.
Yeah, but I think one of the interesting bits is there's no parallel universe. And to your point, you've got to test these things.
Yeah, and Adrian makes a good point. Testing is great and you get these insights, but if something's not working, you've got to kill it early. His point about their unwillingness to close the location due to potential brand damage.
And that brand damage thing, time and time again, I think is actually
100%.
overblown. Founders and investors as well, we can't do that because what will people think? Guess what? People are thinking themselves mostly. They don't really give a fuck about you and what you're going to be closing tomorrow. And yes, okay, you end up in the newspaper that some reporter runs a really negative story. The news cycle is so quick.
Yeah.
It's gone.
And your structural competitive advantage at that point isn't yet your brand. Even if it may go on to be, at that point it's not. So a bit of brand damage, even if there was brand damage, in the scheme of things, it's better to actually cull and kill and move on.
And same with price increases. That's a big area, both in the family office and in the portfolio. That would be too much, we'll lose people. And actually, if you've got something of value and you want to continue to invest in R&D and good product and good service, you might lose some, but often there's a lot of margin left on the table.
Yeah, I think, look, for founders listening, I do hear pre-seed founders even saying, we can't run that experiment in market, or we can't launch that buggy product because it'll tarnish our brand forever. It's like, you have no brand. It takes a long time to be built. At that point, you have no brand. And more than likely, you're going to change your brand in the future when you actually work out what you're doing.
So keeping on the slightly down theme, but I don't think it's a down theme. I think it's let's learn from these things. There was a great post from Tran, who recently stepped away from Go One. Vu's a great Brisbane founder. Vu was actually our first podcast guest, and that helped us because Vu was known. That helped us get this out and about. So I'm absolutely grateful for Vu taking a punt on. Remember, we turned up with the gear in hand to his offices.
When
Vu was so generous with his time to the Brisbane ecosystem.
He's one of the best humans.
But his post, he said, I was asked during the week, during a presentation, why I'd be terrified about the idea of starting a new B2B SaaS business in the current environment. What he says here is the competitive environment across the board, combined with low barriers of entry, mean that building a new sales machine in an early stage startup is harder than ever before. As someone who spent a lot of time on the GTM, there is more noise than ever before. So the first thing I want to point out there, he didn't talk about product first. He didn't go about market. He went, it's sales. And that just often gets so lost that founders build products with cool features or whatever else. It's like,
yeah, 100%. Same observation. Like the fact he went straight to go to market, bloody hard. It wasn't about AI eating our lunch or leading with something else or a macro. It was just bloody hard to do sales.
And I love this next analogy he uses. My analogy for growing a sales machine in the early stages, it's like blowing up a balloon. The first few breaths are the hardest. In recent years, the environment for B2B SaaS, both macro and micro levels, have been made much harder. Trying to blow up that balloon when it's now made of PVC plastic rather than rubber isn't impossible, but a lot harder. And I think he's dead right. And we just see it with a lot of pitches where we invest pre-Series A and Series A, so the first breaths in the balloon have occurred. But that analogy is so right. And best product that's got amazing values still has a lot of difficulty in a really busy market.
I wish Vu would provide more posts like this because I know he's normally reluctant to give value, but every time he does, there's just so many nuggets.
Now, also in the post, he says, it means companies who already have a distribution and are established may likely extend their lead. Incumbency is possibly more powerful than ever before. Money seems to be flowing into the incumbents and the cost of capital for early stage businesses is getting worse. The canary in the coal mine is the number of VCs to close their own fund at the moment.
It's definitely something we've been talking about. See, it's possibly more powerful than before. I really like that line.
And he uses the example of the Magnificent Seven. Good luck coming up against them.
Yep.
If you're an early stage founder raising, he says, I dare you to ask the VC opposite how their latest fundraise went and what the LP market is like. You might see sweat. Only problem is it's not sweat, it's tears.
Hey, look, we talk about it pretty transparent. It is bloody hard out there for the VCs, for investors to be raising capital.
Yeah. And then his final point of the post, technology is changing so quickly, it's hard to plan long term and speed is becoming more important as a weapon, while capital to fuel that speed is decreasing by the minute. Your competitive advantage may evaporate tomorrow with the next demo from OpenAI. I think, and that comes back to one of the themes earlier in this episode, just speed and getting out there. And he says, as a result, early stage companies who smash it early and undertake founder-led sales may get to 1 to 5 mil ARR quite easily, but then the 10 to 50 mil ARR environment is far more challenging. He does end it by saying all is not lost. Those that can break this barrier will likely not only survive, but thrive. He wants to be clear, B2B SaaS isn't dead, it's just much harder.
So fitting with the theme of this episode, his other line there, evolution occurs due to diversity and adversity. And failure is inherent in that process. To the founders in the trenches today, keep chewing glass and staring into the abyss. It's the best way to feel alive. You definitely know you exist.
The best way to feel alive? No. It's a way to feel alive. And on the other side, no.
Yeah, but look, good insights for founders.
It was one of the topics that came up at this VC dinner because I was meeting some new people and they're having a chat and they say, oh, so you do B2B SaaS? And yeah, we did, but we're actually getting a bit, negative is too strong a word, but we're just finding less and less companies that can jump over some of the competitive barriers that are coming and have the ability to really differentiate and create a go-to-market, i.e. generate low-cost leads that are of high enough quality for a good quality sales team to convert into sales. And that sales team may be a field force, that sales team may be sitting behind a desk, but actually getting that little chain of events done cost effectively so we can actually make some long-term value and then be able to do it at scale systemically, just not finding enough of those that have that solved.
Yeah. And it's interesting when people introduce Tribe and I hear them say, oh, these guys invest in B2B SaaS. I'm like, no, I have an adverse reaction to that as a category.
Better update our bloody website.
No,
then,
we
Aaron.
have. It says tech enabled. So we've even gone beyond B2B tech to say B2B tech enabled.
Yeah.
And we do have a kind of an emerging thesis in this space. But the other part of what you said there, Don, so much of our pitch calls and our pitch process is now heavily geared on the go-to-market and the marketing and sales engine, like understanding how the founder is thinking about and how have they worked out raising awareness through to conversion, through to retention, through to actually scaling and growing existing customer base. And the mechanics of that are not easy to work out, but that's where we spend the majority of time doing our early analysis on companies.
Yeah, and I suppose any founders thinking like, what are you trying to do with the go-to-market and your sales and marketing machine? All you're trying to do, and it's not easy. So when I say, the golden thing you're striving for is trying to build something that is repeatable, reliable, and efficient, because you just want to be able to keep allocating capital to the process, and then you're getting a return, and you're just growing, compounding. And that's ultimately what you're striving for. And that's what we're trying to help you build the system that enables that.
Now, by the time you come and talk to us, we're not expecting perfection. We're not expecting that everything is perfectly nailed. What we are expecting is an understanding that is required. We are expecting some experiments or some tests to have occurred in those spaces. We are expecting some kind of cogent roadmap of how you're going to get to that. If you're turning up with the product's going to sell itself, founder-led sales forever, we've got a problem. And that then segues to something that Jack and I spoke about offline last week, but Vu's first few puffs of the balloon just remind me a little bit of this next article, which really isn't a tech company. But when PwC shit the bed with its bad behavior with the tax side, they sold that part of the business for $1. They rebranded Scyne, and then it effectively started life. Now, in the first year, it's clocked up 200 million in revenue after almost 500 project wins. Now, the point that I squeeze that into this is that nothing beats relationships, networks, existing relationships. And if you think of the first few puffs of a balloon, going after that low-hanging fruit, going after those people you already have deep relationships to get that momentum, rather than going after everyone, 200 million in the first year.
Bloody hell. Well done.
And I suppose like we seem to draw back principles for founders, but I think there's a lesson here for investors. And we speak about NZ companies. You might be analyzing a company that's come out of the gates really well, but you just have to appreciate, in particular in New Zealand, like it may be relationship driven. And at some point they're going to be exhausted. And then you're going to have a systemic machine that can find a repeatable, reliable, and efficient way to get leads and convert them. So it's just a watch out for any investors listening, because it's really helped me understand and appreciate it.
Yeah, spot on. And we've talked about this. Yes, the New Zealand market with that high relationship driven, but also for a founder that's already got high relationships in an industry or a sector in their current market. It is a bit of a watch out. Like, how do they systematize that sales and marketing engine independent of just relying on those relationships?
And that's why, like, when you're expanding into an international market, there's so much execution risk. Like, you're restarting and it takes way more capital than you forecast, and it's a hell of a lot harder than you initially think.
Yeah. And even if you've done all the right things building that engine in your local market that's not reliant on your primary founder relationships, it could be a whole different ballgame in that new market in terms of how that engine needs to work. And so it's back to day zero in many cases.
And I think Vu from Go One's the textbook example, like about how they expanded into the US, and they took one co-founder with 2 sales people and they worked the graveyard shift in Australia trying to close deals in the US. That is that's the most cost-effective way to get enough feedback and conviction to believe that there is a demand in the new market. And it's not hard. Like, that wasn't something that they had to go pay some big go-to-market strategist to do. They just thought about it. They knew it was going to be hard work, but it was the most like realistic way to get a proof point. And they went and did it. Like, I just love it because it's so simple. It just required hard work and they got enough feedback and conviction.
100%. It's such a good model. It's efficient. You're selling from the mothership. You've got the founder who already has the domain knowledge, as opposed to an approach that's commonly used that fails is to just go straight out and hire someone in that market who has existing relationships, who's typically coming from a later stage company that when you actually unpack what they did day to day in that role, it's pretty myopic in terms of their capabilities.
Well, they were order takers from larger companies because they had this machine of warm, hot leads for a brand that was already established, and who thought they were a great salesperson. They were just a order taker and a closer.
Yeah.
A lot of great lessons from Go One. Like, any founders really recommend listening to that episode and consuming anything that Boo or any of their team posts.
Yeah.
Absolutely. That's the schedule. Shall we get into some Sharts?
Sounds good.
So, this first one. If Index Ventures, so one of the world's great VC firms, was a country, this is the number of unicorns and $1 billion plus exits. The United Kingdom, 176. Index, 180. Germany, 69. France, 54. So this one firm is producing more unicorns and $1 billion exits than countries like Germany and France, and only just slightly less than the UK.
But actually more, far out.
And this is the flywheel, right? Momentum begets momentum. Like, once the best founders come to you, the best deals arrive, the best LPs want to work with you. That's partly what we're trying to build, this flywheel.
Yep.
So we've been talking a bit about the US markets. This is a chart here, which is the S&P 500 price to earnings forward ratio versus the Bloomberg Economic Surprise Index. And so what the Bloomberg Economic Surprise Index sort of measures is when things surprise to the upside versus when things surprise to the downside, and then they net those off. And what we're seeing is a big divergence. The Bloomberg index constantly is surprising to the downside. So there's a lot of data that's coming out that's worse than anticipated. But actually the forward momentum, the forward multiples of the S&P 500 is still going up. It's still going in the opposite direction. So either the market's right and all this data is short term and the surprise index comes back to meet it, or the market's mispricing.
Yeah, in this time period, this chart, which runs from 2018 to 24, what is it, mid-21, when that diverged in a similar pattern, although to a less smaller extent than now, and then the S&P 500 dropping down into B.
Yeah. Now, there were some inflation prints that came out the other day, and then what happened was, I'll show the second chart first, the 2-year yield dropped heavily, because this was another signal that they're going to have to start cutting interest rates in order to have a softer landing as possible. But what was interesting is this is the NASDAQ 100 versus Russell 2000. This is the blue line is the NASDAQ futures, and the red line is the Russell futures. And you can see investors on a futures basis made a big pivot. With the data that came through, they went, holy shit, we're probably going to see the NASDAQ come down, and this is going to give an opportunity for the Russell to start to outperform. Because, that just, for those listening at home, these two charts just invert. Just a big pricing difference between the Russell. So people bought the futures saying this is likely to go up, and they sold the NASDAQ.
And it just shifted immediately.
Yeah. There are things that happen behind the scenes and this is going to be interesting with the dawn of AI, like AI being able to take all of these data sets, like that data set from before, and just feed it into a machine. It's going to be interesting. This is a chart that shows the market share of DoorDash, Uber Eats, Postmates, Grubhub, and other. So these are like the food delivery and last mile delivery stuff. DoorDash is just an incredible story of eating, pardon the pun, the market share of everyone else.
I would not have picked that, but look at that.
So for those at home, like DoorDash in 2018 had maybe 20%, and now it's coming on 50%. And all of that has just been taken out of Uber, Postmates, probably Grubhub. Grubhub's the one that's really, and this is, so if we take this as the food delivery and last mile space, this does demonstrate founder/management teams. You can still be in a busy environment and you can still have a better product, better service, better outcome that strips market share from others if you back the right founders. Yeah. You guys were so impressed with my last aeroplane one. This is a chart that actually breaks down the revenue from a flight. So how much money they pull. So this is a 10-hour flight using one of those A350s or whatever. So $50,000 in first class revenue, 70,000 in business revenue, economy's 120, and other revenue like excess baggage and stuff is about 10. So that gives about 250,000 of revenue. Fuel on that flight is $72,000. Labor is 67,000. Airport fees about 8. Catering's about 5. And then gross profit for operational costs like depreciation, insurance, miscellaneous, and that ultimately leaves a gross profit of $28,000 a flight for head office. Now, what's interesting is labor costs. It just splits additional labor costs, cabin crew, and pilot and co-pilot. So the pilot and the co-pilot roughly get paid the same amount as all the rest of the cabin crew. Probably makes sense.
I'm just looking at the gross profit margin per flight and just how many passengers they need to be short for that just to be eaten away. Like it's...
Yeah.
There are so many other costs that you have to include further down the P&L.
100%. And the factoring in delay costs and other things. Imagine it's tight.
Like something like a point that Charlie made in his book was like, for the amount of innovation the airline industry has brought to the world, that they just haven't returned the capital that's deserved. Like it's a notoriously bad industry to invest in, but they've just dramatically improved the quality of life for the entire world.
Yeah.
A commodity product subject to competition, the marginal profit always goes to zero. That's the problem.
I was saying to Mara this morning how great it is that I could jump on a flight, go and be in Adelaide for a day and do all that and come back, and it's just normal business now. But yet you look for the cheapest airfare to get you there and do all that. And it's a very cyclical thing. Like I remember investing, Qantas just had this share price cycle that was so predictable, and you could just put some options on it, do reasonably well. It's changed since COVID, but it's a bloody tight model.
Yeah. So I don't know if you've seen these doing the rounds on social media, but for listeners at home, this is a meme that's got that scene from Titanic where Kate and Leo are spinning around on the dance floor. So this one says, I studied economics. That's Kate. And then Leo saying, I know how computers work. Final one is, let's YOLO and fund a whole lot of AI companies. Another one I saw that I couldn't find is, I'm a junior sales rep. I'm not a decision maker. Great, let's waste each other's time in the sales cycle.
Oh, that is spot on.
So that's the best I could do with no socials. They really were Sharts.
Don, can we get an update? How is it? Is it
So
2 weeks
good.
now?
2 weeks. And then I'm doing dry July on an alcohol basis as well. So no alcohol. I tell you.
Are you getting withdrawals from social media? Are you over the withdrawal stage?
No, but what happens is it's just amazing. It's easy to default. So as an example, I had to go the other day to find Tribe's YouTube, or one of the videos to send to someone. But YouTube now has like a TikTok reel thing.
Yeah.
So I was in there and then I just saw Ricky Gervais. And I thought, oh, I like Ricky. Dead set. 8 minutes later, I catch myself. I'm like, been scrolling this whole time. Get back to like, it's just
YouTube is a shocker. That's the challenge. Like we have content on there. That's my watch out is YouTube.
What do we got planned for the weekend?
I'm going to take the kids up the sunny coast for a bit, just have a bit of beach time and chillax. Not much else planned. What about you boys?
I'm doing the Brisbane Valley Round Trail
nice.
with 3 friends.
Is that a ride, Don?
Yeah, 180 Ks. And so you start in Ipswich and you go through all of the old rails from 100 years ago, through the tunnels, through the bush.
Oh, that's awesome.
Night. We're gonna kick off Friday Arvo, so we will stay Friday night.
Yeah.
And then Saturday night, and then come back Sunday. Jack, what about you?
I don't have much on, so we got another bye. So the team we're versing forfeited. So we got another low-key weekend, just do house hunting, having a look around, but yeah, quiet weekend.
Nothing's popped up?
Yeah, there are like more coming on the market, but it's just super competitive. So like the right one will come. We just got to keep looking, keep your hat in the ring.
Looking at the clearance rates on auctions and looking at the number of people at the open houses and the fact agents are now hunting out buyers, like the bloody number of phone calls.
Yeah, so we're still not at that phase, but I've had 2 signals. So 2 properties that I've been looking at have decreased their initial price. So it's not a trend yet, like it's 2 data points, but I do agree.
All right, good. That's
all right, guys.
All right,
see you later on.